Hi guys, Ashton here with Diggs. As always, bringing you tips on how to save for and eventually purchase your first home. If you've started looking for a home, chances are you've heard the term PMI. PMI stands for Private Mortgage Insurance, and it exists for a very important reason: to provide you a way to become a homeowner without providing a full 20% down payment. Unlike normal insurance, you're paying the premium to protect someone else, that is, the lender, which causes part of the confusion, and we'll get into that in just a minute. For now, let's start with a practical example of how PMI works. Let's say you're purchasing a home for $200,000 and you put 20% down, or $40,000. Down the road, if you miss your payments and the bank forecloses, they have enough security, your original down payment, in the property to cover things like missed payments, repairs, and reselling the property. Now let's say that you are purchasing a home for $200,000 and you are putting 3.5% down, or $7,000. In the same foreclosure situation, the bank may end up with a loss if they only have $7,000 to cover the missed payments, repairs, and resale. And it comes as no surprise, lenders don't like to lose money. As the homeowner, you pay the premium, but in case of a default, PMI covers the lenders for the reasons I just mentioned. But that's okay. There's nothing wrong with paying PMI, especially if you don't want to wait until you have that 20% down payment saved. There are some instances where PMI is not required even if you're putting down less than 20%. For example, buyers who are eligible for FHA or VA loans. Both of these loan types have different pros and cons, one benefit being that they don't require PMI. However, there are other fees that are similar and may be more expensive in the long run. At the end of the day, the less down payment you put down, the more likely you'll have some costs to help offset the risk to the lender, so keep that in mind. So how much does PMI typically cost? Plan for between 0.03% and 1.5% of your total loan amount. Where you fall in that range depends on how much you put down, your credit score, the total loan amount, and the interest rate on the loan. The last thing you should know about PMI is that it's only temporary. Once you reach 20% equity, meaning you've paid 20% on your total home value, PMI is no longer required. If you reach 20% and didn't realize it, don't worry. PMI will automatically drop off when you reach 22% equity. There are other ways to get rid of PMI, which you can read more about in the link below. I hope this helped bring some clarity to PMI and helps you purchase your home sooner. Thanks for tuning in. Until next time.